Everyone, this is Gary Wilson, and welcome to tonight's live Path to Profit webinar broadcast. It is live, and we are not recording, so welcome aboard to everybody, no matter where you're from, U.S., Canada, West Coast, East Coast, and the Caribbean too. So I think that's the first time this has happened, but that's awesome. If you are new to the program, we should have a lot of people who are new or newer, particularly from Pennsylvania, a couple from Virginia, and let's see, definitely Massachusetts, okay? Some of the newer folks, New Hampshire and Vermont, and then before that, of course, Canada, Quebec, and Ontario. So welcome aboard to all the newer folks. If you are fairly new, this is live, and also you're by default on mute mode, because we can't have everybody on live, audio at the same time. So I may unmute you from time to time. If you do have questions, please use your question box to type in the questions. Okay, and I'll get to all the questions before we're done for the evenings. Usually we're done in an hour. Sometimes it takes a little longer, but this is your show, so I'm going to give you the best I've got. And I'll ask you that you hang in there and let me know when you have questions. So let's see, we did have somebody just pop in. Hey Daniel, how you doing, buddy? Good to see you guys on board. Got the Daniel Cohen team. Okay, by the way, one more thing before we move on here. Just remember, you do actually get the recording of this the very next day. And when you do, please look at the email from Beverly. She often provides instructions in there, updates to the system, updates to the content, the upcoming webinar schedule, and a lot of things that she takes care of on the infrastructure side that helps all of us stay in contact with each other and communicate and have current data, and also systems that will help us communicate with each other again. So in any case, if you could do that, that would be wonderful. And without further ado, let's go ahead and jump into tonight's subject. And here is tonight's subject. Miho and I had a great strategy call. I think that was actually yesterday. It was yesterday. And prior to that, she sent an email to me, a couple emails asking to go over a few things. And I thought the first one would be ideal for our weekly webinar for all the investors and the agents working with the investors. And the subject was I happened to mention rent rolls and P&L in one of the prior webinars. P&L stands for profit and loss, okay? Relative to investment real estate, okay? Obviously, predominantly that's going to be your rental properties. So what I did is I brought up some samples for you of rent roll. This is a rent roll we're looking at here, and I'm also going to show you an example of a P&L statement, okay, which is right here. I'm also going to show you, by the way, I threw this in Miho, a sample of a balance sheet. I didn't have one I could find on my computer, so I got this one from Walmart, of all places, okay. So look at a balance sheet, and then also we're going to look at a sheet of items that you should be concerned with when you're buying rentals, okay? These are all the things you look for. We're going to go over this in a little bit of detail towards the end of the webinar tonight. So let's go ahead and get back to the beginning, which is the rent roll. So rent roll, by definition, is literally an itemization of rents that you've actually received by tenant, by unit, by property, in that order. So in other words, the finest level of detail is by the tenant, okay? And it's going to show you literally month to month. So if you have a year's worth of a rent roll, it'll show you all the rents coming in for the tenant for the year. Now, if the rental unit had turned over, in other words, you've had a turnover of tenants during the year, you would have actually a new entry put in there for the new tenant. Now, I think what we're showing you here is, we'll just go over here and scan to the right, July through December. So this is the last 6 months of whatever year this was. I'm not sure. I think it was 2011 actually. Okay. So in other words, if you look here, is unit 701. Okay. You got the size of the property, 2-bedroom, 1-bathroom. That's what that 2B, 1B means. You've got the lease dates. This is important. The lease start date and the lease expire date. And you can see, by the way, real quick here, I just want to point this out. This unit was leased on April 24th, okay? And what we did was we had it go through and past the anniversary date to the end of the month, the anniversary month in the following year. I think there's actually a typo here because this says 2013 to 2015, and all of our leases were actual 1 year or annual leases. They weren't 2-year leases. So, but nonetheless, this would save, if this was leased on April 24th of 2013, it wouldn't expire until the last day of that anniversary month in the following year. In this example, that should say 2014. Okay, the month that person's paying, the person's name, the deposit they paid. Okay, of course you've got comments. Pre-12. Let's say if they owe any money, that will go in that column. Okay, and then here's all the rents they paid every single month. Okay, so that's essentially the anatomy of rent roll. Now let's just go ahead and scroll down here and show you a little bit more how this thing is structured. It should be structured in some type of a logical fashion. In other words, this is a building, and in this building there were, as I recall, 26 units, and there were 3 buildings to the complex. Okay, building 75, building 77, and building 79, if I'm not mistaken. Okay, so if we look here, we've got the 7,500 building, the 7,700 building, well, I'm sorry, excuse me, the 8,500 unit building, 8,700 unit building, which is down here. Okay, the 9,500 building, and the 9,700 building. But let's just, and then we've got garages. We'll go over here in a minute. Let's go back up to the top. So this building structure contains 26 units. Okay, if you notice here, here's an example of where a unit is in here twice. That's because there was a turnover during the year. First part of the year it was rented to Amen Gurung, and then partway through the year that person moved and it was leased subsequently to Amber Singh. Okay, that's 8519. So that there was a turnover there. So that had there was another one here, 8521. Also had a tenant move out, another tenant move in. Okay, Herman moved out and Bakhta move in. Then, so the bottom line is for that building, we're bringing in essentially $21,680 a month in rent, and we actually collected $20,228. This person looks like they're behind on a rent right here, a little bit anyways. Okay, so I don't know what the collection rate is. That's probably over 95%. This actually was one of my favorite buildings because the collection rate was always consistently over 95%. Okay, so that's one building. We have a subtotal there, right? Subtotal that we should be getting, subtotal for deposits. Excuse me, this is the deposit column. Okay, and then down here on the right is the subtotal of the rents collected. Okay, all right, so that's that building. Now let's go down to the next building. Same thing. We've got the building number 85 and 87 and 95 and probably 97. But in any case, we have the tenants, the contract rent, the deposits, what they've actually paid. We got vacancies identified here. Okay. At the bottom, we've got the subtotal for the second building, and then we've also got so far the accumulated total of both buildings, 42,000 so far for those 2 buildings. All right. And then down here we got all the garages. We had like 30 garages, I think, for this property. So far we got 42,000 in apartment rents. We've got 1,800 coming in for garage rents, for a total of 44,000 for the month. Okay, so that's how we do rent rolls. So real quick, before we go any further, rent roll is the easiest thing to show you. That's why I showed it to you first. So let me go over here to question box and see if you guys have any questions so far. Okay, let's see. Hey Dennis, is your sound okay now? I just saw your email. Mine looks like I'm okay on this, and the boom's working, the mic's working. And I've got 100% on the oh, you're good. Okay, sorry Dennis, didn't mean to interrupt there. Okay guys, that's rent roll. Now that's the easiest thing. That's why it only took a few minutes. So oops, sorry, we do have a question. Hang on one second. Let me go back here. Hang on one second. Okay, here this is from Pablo. Hey, Pablo says, do you also use a software adjust Excel sheet? Yeah. So Pablo, for rent roll, we just use a basic Excel spreadsheet. There are products you can purchase online, but quite frankly, it's such an easy tool to create. So Excel is an awesome tool to use, and it's easy to set up. It does all the calculations for you. We just never really saw it necessary to buy another product. We'll get into, if we have time later on, I get into some other things you guys can use. Like there's a tool called Propertyware, okay? You may want to write that down. Propertyware came out several years ago, maybe 10 years ago, and it was a pretty good tool. And they've improved it over the years. In fact, they've improved it so much that all of the outfits that are serving or servicing, say 500 or more units per month, most of them are going to Propertyware. I actually met the guy who created it, and I met Andrew Waite, who's the creator of Real Estate Investor Magazine. He's the one that first turned me on to it. And he said it's probably the best thing he's seen. It's sort of like Infusionsoft is to contact management. This Propertyware is the same thing to real estate rental management. Okay, awesome. And they have so probably they have some stuff in there you can use too in Propertyware, right? But back to this, yeah, we just use an Excel spreadsheet. Now what I want to do is show you a P&L. Okay, now P&L stands for profit and loss. It's literally just like it sounds. You plug in your profit, in this case, what the rental income is for the year. Okay, in this example, $435,826.50. Okay, utilities income. I'm not sure why I would have had utilities income. Maybe it was a reimbursement or something. Okay, and gross profits. Now, in here, what you're not seeing is laundry. Okay, laundry should be in here. If you have laundry services for a building, that should be included in there. If you also have storage, if you have storage bins for your tenants, you would charge separately for that. We used to charge for storage, by the way, too. And sometimes we got anywhere from $35 a month up to $100 a month, depending on the size of the storage unit. Okay, but under income, you would include all those different incomes as a separate line item, right? And total all those up. And that's your gross profit. Now, if you notice here, we go right into expenses. Generally, what you see up around here is a line item for vacancies, and then you would, it's usually a percentage, and you subtract your vacancies from your gross profit. Okay, net is what you actually had coming in, the actual money you had coming into the property, right? Now, down here we have all the expenses, and I'm not going to spend a lot of time on this, but I want to go over a few basic things. You'll see there's automobile expense in there, okay? I think for this property, we had a truck that we used that we would let our maintenance manager use. But the property, the LLC that owned the property owned the truck. We didn't own the truck personally. We purchased it under the LLC for the building, okay? And there were some expenses associated with that, and that's what that expense is. Buildings and improvement, okay? Now, generally speaking, you're not expensing buildings and improvement in the year you took the building and improvement costs. Building improvement generally goes against your cost basis of the property. It's a capital item, so it adds to the value of the building. And it's also depreciable. You would depreciate, for example, the cost of a roof, right? You would depreciate the cost of appliances and things like that. Now, there's different line items for that if you had them in here, because the reason is you would depreciate a refrigerator differently than you would depreciate a roof, for example, okay? In any case, you got filing court fees, insurance expense, that's the property insurance on the property, mortgage. Now, this would just be the principal and interest portion of the mortgage, okay? Pest control. Most parts of the country, you got some kind of pest you got to control. So that's pest control. Postage and delivery. As you can imagine, when you have a bigger building, that can add up to be a little bit. Rent expense. This is if you're, for example, in the big building we were using a moment ago on the rent roll, one of the units we took and used as a management office in the building, because the building was quite big, all right? So that cost us $500 a month. So we charged ourselves $500 to rent that space, even though we technically owned it. We owned the LLC that in turn owned the building, and So our management company paid the building, paid the LLC that owned the building $500 a month. Okay. Repairs and maintenance, and that's all the stuff that you do expense in the year you took it. Now, by the way, there is some argument. I'm not going to try to give you tax advice here, but there's a rule called Tax Rule 172, and it is interpreted by some tax advisors that you can expense a capital improvement in the year you took the hit as opposed to depreciating it. Okay, and I think that's what we chose to do here. I'm not advising you to do that. I'm just telling you it may be something you want to ask your tax advisor about. Okay, this down here is just routine maintenance and repairs. This is, changing doorknobs, painting, cleaning, stuff like that, all right? Small tools and equipment. Yep, when you have a decent sized building, you're going to be buying things like lawnmowers and snow blowers and electric eels for cleaning out sewers and things like that, okay? Supplies would be something different, like tools and equipment is actual mechanical or electrical machinery. Supplies is more like, paint, nails, screws, wallboard, trim, things like that, okay? Taxes, of course, is just like it says, taxes. You got to pay property taxes on these properties, and telephone expense. Believe it or not, this can chew up some expense in a decent-sized building because you have one line for the office, you have another line typically for your security system, which is where the real expense is. And if you have multiple buildings in a complex, you're going to have separate phone lines. In other words, in the example I just gave you, if there's 3 buildings, there will be 2 phone lines per building. Okay. Utilities, you can break this out obviously, but that's going to be your gas, electric, water, sewage, things you're paying in utility expenses. You can see expenses chews up quite a bit of money. All right. But at the end of the day, you're left with a good chunk of income, and that even includes the fact that you've already paid your mortgage payment. Okay, so not a bad day at the office on that one. Any case, let me go to the questions and see what we have here. So let's see, that was Pablo's question. Okay, Cedric. Hey Cedric, how you doing, buddy? Hey Cedric, what we're thinking is Miho and I and you, if you want to join us, is Saturday, November the 11th at the at PF Chang's in Woodland Hills, right across from the Marriott. That's where I'll be staying. Okay, there's a big giant mall right behind it. I can't remember what the name of the mall is. Miho may remember, but we'll get that to you in an email, right, or a text. Okay, Cedric's asking, Gary, these look like annual expenses versus monthly expenses. Cedric, that's absolutely right. So you definitely want to track these things on a monthly basis. But when it comes to reporting, you report them on an annual basis. In fact, it says here January to December 2011. So as the year goes on, like there's different versions of this profit and loss. I use, by the way, everybody always asks us, so go ahead and get your pencils out and I'll tell you what we use. Even today, we still use QuickBooks, okay, for basic accounting. Some of the other property management systems have bookkeeping built in, like Propertyware. They have a system you can use. I like QuickBooks Pro because it's designed almost ideally for people who own properties. Okay, and you don't even have to get the Pro version. We did because it has more bells and whistles. But you can set things up by class and type and things like that. And this is, if you don't know what these terms are, guy, don't worry about it. You can get the basic version of QuickBooks and play around with it. You can also get QuickBooks Online, the cloud version, which is actually quite affordable. It's like, I don't know, $13, $14 a month. And the good news with the cloud version is you don't ever have to buy any upgrades. They upgrade it for you automatically. If you buy the software, it's usually a couple $100, like $200, and you're thinking you might save money because you'll use it for forever. But just know this, they're going to make updates to that system every year. And partly because the IRS makes updates to their code. Okay, and by the way, we use QuickBooks up in Canada too. And same thing, the tax codes change, so the accounting software has to change. So I just figure, you know what, I'm better off just doing the cloud version. But in any case, what I'm getting at, back to Cedric's question is, you can get reporting that gives you the monthly figures in a chart that allows you to compare month to month, so you can see trends develop, okay? So in other words, the first month, January, I would get January and then a running total. And then in February, I would get January, February and a running total. And then in March, I get January running total, so forth and so on throughout the year. That's really how you should be looking at your performance of your properties, okay? And then what I do is if I see something I want to question, I can click on this. And I can't do it here because this is an actual Excel spreadsheet, not the actual QuickBooks itself. Click on that line item and it blows it up and shows you all the details. It shows you all the charges that made up to $23,22.85 for the automobile expense, okay? You can get down to the nitty-gritty individual charges, which you definitely want to do. Which leads me to a very important suggestion here. I'll just, matter of fact, I'll call it a command, okay? I hereby command you to look at your property data at a minimum on a weekly basis. I know owners should just look at it monthly. I think that's too risky. If something sneaks by you and you don't catch up to it till a month later, it's often more difficult to undo something once a month in has gone by. So I look at stuff on a weekly basis. It's easy. I get in the habit of it. It takes me nothing more than a few minutes per property and I'm done, right? There are properties I will look at on a daily basis. I can go online and see the activity occurring that day. I'll do that for a new property. So please write that down. When you first acquire a property, look at it on a daily basis, okay, until you feel comfortable that it's stabilized, and then you can look at it on a weekly basis. And if you're really comfortable, yes, you can look at it on a monthly basis after that. But I still look at it weekly. That's just who I am, okay? All right, so that's Farrell's question. Let's go. We got Cedric. Okay, rent expense is probably copy or something like that. Rent expense. I think oh, that's only $500. That's right. That's for the year. So that you're probably right. That would be that probably is going to be copier, fax, scanner equipment. Okay. Okay. Let's go down to the next one. This is Faisal. Hey, Faisal, how are you? Where is the vacancy rate? Yeah, Faisal. Actually, I mentioned that in the beginning of this little section here. It's not on here. It should be, and where you would see it, Faisal, generally is right up top here. After you see your income categories, line items for all the income, laundry, storage, and of course the apartment rentals themselves. You total that, then underneath that you would have your vacancy, okay, and you would whatever your vacancies cost, you would put that in there, and then your net is what your actual gross profit is, or net profit. I'm sorry, that's your net profit. So that's where vacancy rate would go right up there. And vacancies have been actually very lean in the last several years. I mean, we're talking nationally, average of 2 to 3%. In some areas, it's as close to zero. Okay. Okay, let's see, Luann. Okay, how do we calculate the vacancy rate? So Luann, if you're doing a pro forma like a projection, one of the best things you can do is use a rule of thumb. And most people would say, let's just plug in 5%. I mean, that might feel good because it's conservative, but I would actually venture to suggest that you get the actual average for your area. So what you can do is, if you call your local property management association, you can ask them what is the average vacancy rate right now, and they'll give you the average vacancy rate, and you can plug that in. Now, when you're looking at actual dollars, you want to put in the actual dollars of the vacancy. So if you have a building with 100 units and 3 of them are vacant, you're going to not just put in 3%. You're going to put in the total of the 3 rents that you're not collecting. You put in the actual dollars. Okay, so it's actual versus projected. Good question, by the way. Let's see. Dennis is asking, okay, what kind of variables would you be concerned about that would cause you to examine a property daily? Which really, for me to look at something daily, Dennis, it's really more a factor of it that it's new. So when I first acquire property, I'm going to be like the fly on the wall. I mean, I'm literally going to be looking at that thing and not let anything escape my view. Because it's a new building. It's just like when you hire a new person, you're going to be more involved with them in the beginning, more hands-on management. And then as time goes on, it's less hands-on. It's the same thing with a building. It's just that it's new. That's really, so it's a factor of it, Dennis, being new. Now let's say I look at any property and I see something that's alarming. Let's say I'm looking at maintenance and repairs, and I thought in my mind it was averaging 20,000 a month. All of a sudden I see 30,000. I'm gonna click on that and plug it in and go back and see all the details for the last whatever it is that is. In this case it's a year in this example. But so Dennis, the second part of your question, I'm kind of filling the gap for you here. When I go look at something in more detail, it's usually because it's outside what I would consider the range of normal for that particular line item. Okay, but back to the property related question, it's more a factor of it being you than anything else, which is why we'll look at it on a daily basis. Okay, this is Luann. Luann says, okay, do you know a few local property management companies I can call in Montreal from the top of your head? Yeah, I'm not sure, Luann, off the top of my head, but what I would do is, what was the guy's name that was in there? When I was up teaching in Rock's office, Luann, to my left against the wall was a couple of guys. The two that were closest to the front, I knew them from 3 years before, and the one guy with the chain, he was heavily into investors. I bet you he could give you a couple of companies. What I would do, Luann, also is go to your local investor club meeting. You got several of them in Montreal, and ask them who are the local property managers that people are using, and just get a good idea of which names pop up more frequently, and that would be the ones you want to use. Okay, I think we're caught up on questions, so let's go into the next thing, which is a balance sheet. So, Mihu, you didn't ask for this, but I wanted to go ahead and add it in there because generally speaking, when you're looking at a business, you want to look at their balance sheet too. Now, when you look at rental properties, they do actually have a balance sheet. I mean, we have balance sheets for every property we have that's in an LLC. So the LLC would have a balance sheet because you have to file that when you're paying taxes. Okay, but in any case, balance sheet is literally showing you assets and liabilities. Okay, primarily we're looking at assets and liabilities, and typically your assets on one side and your liabilities are on the other side. Now, assets are what you own, O-W-N, own, and liabilities are what you owe, O-W-E, okay? So this isn't income expense. Income expense would be, income would be rent, and expense would be the interest you pay on a mortgage, okay, mortgage payment. The balance sheet is showing you the total value of the property that you have a mortgage on, and the total value of the loan against the property, the principal balance of the loan. That goes on the balance sheet, not the actual payment, but what you actually owe, okay? First things first, you're always looking at cash position. So when you're looking at properties, again, I'm not really going to be asking for this when I'm looking at a little duplex, but if I'm looking at a 100-unit building, you better believe I'm going to look at the balance sheet. Okay, now they might not want to show it to me, but a balance sheet lets you see from 60,000 feet if they're in trouble or not. And if they're in trouble, you want to know why, and then you're going to go look for more information. If they're not in trouble, hey, no harm, no foul. Okay. In any case, cash equivalents is always the first thing I look at. I want to see if they have cash on hand. If they do, that generally is a good sign about the property. I want to see how much they have coming in. That's receivables. That's what they're expecting to bring in. Okay, they haven't actually collected yet. Inventories, so this is going to be your actual properties themselves. And prepaid expenses, rather, this is something you paid in advance, so that's what that is, total assets. Okay. Now we're looking at the cost of, in this case, the buildings, right? The land in the buildings, fixtures and equipment. That's when you're going to add up, for example, your refrigerators and stoves and things like that, and your lawn mowers, your snow blowers, your electric eels, things like that. And if you have a truck, you'd put a truck in there too, and you add all that up, and that goes in there. Okay. Now you have also, and you have to account for this. This is called depreciation. Depreciation, a lot of people misunderstand. A lot of people think, well, I'm going to get an extra tax write-off in the form of depreciation because I own the property. My taxing government is going to let me write off 3.41% of the value of my cost basis, excuse me. Cost basis of the property on an annual basis. That's true, but it's not like it's free money. What happens is every time you take a depreciation, you're basically reducing your cost basis by that amount. So the net effect is this. Let's say you bought a building for $100,000 and you depreciated it all the way down to zero over 27.5 years, okay? And then you go to sell it for $200,000. Well, you're not going to pay taxes just on the $100,000 gain, the difference between $100,000 and $200,000. You've got to do what's called recapturing the depreciation. So all that money, all that depreciation you took over the years, the $400,000, you've now got to pay taxes on that, okay? So really all you did is you deferred, you actually get the free use of money for a short period of time, but only temporarily until you sold it, then you got to pay on that, but it's interest free, you know? So you basically get interest free use of funding. That's what that is, okay, depreciation. All right, anything under capital lease, we're not really going to spend a lot of time on that because quite frankly, our buildings we're owning them to rent them out, we're not leasing them in this example. Okay, so that's total assets. Liabilities, this is where you're going to add up your loans. Hang on, let me reduce my panel here. So loans, accounts payable, this is if you owe, if you have a backlog for, let's say you bought a bunch of roofing material to do a new roofing job and you put it on credit, okay, you'd want to account for that here. That's a liability. Accrued liabilities, accrued income taxes. So this is taxes that you haven't paid yet, but you've accrued. Okay, in other words, they're building up over the year. Long-term debt. These are your, generally speaking, your mortgage, the principal value, the principal portion of your mortgages. Okay. Now you've also, let's say we're not going to talk about stock because we're generally not selling stock in our properties. When you can own the properties in a corporation and sell stock, but that's not generally what we're doing here. In fact, you generally would never own real estate in a C Corp. You just wouldn't do it, okay? However, you can create what's called a closed-end mutual fund or a REIT, real estate investment trust, and yes, you would sell shares of the REIT or sell shares of the closed-end mutual fund and then use those proceeds to buy properties, to buy the land and buildings over here, right? Okay, in any case, you add up all that, the debt and equity. By the way, you do count equity in here. In other words, let's say you weren't selling shares, but you had 2 or 3 partners in the ownership of a property. Each person is going to have some share in equity, and you put that in there. And with the bottom line, what happens is your liabilities plus your equity added up over here equals your total assets over here, i.e. you're in balance. That's why they call this a balance sheet. The left side must equal the right side, okay? So what you owe minus what you own is your equity, okay? So in any case, that's a balance sheet. Let me bring the panel back over here before we go into the last segment of the class. Let's look for some questions here. Let's see. Okay, so we got Luann's question. Okay, here's a Pablo. Pablo, is it better to have one LLC per building or combine them in one? Well, Pablo, that's actually a personal choice for me. What I decided to do early on is I never wanted to own more than $1 million in real estate in any one LLC. So I just kept setting up multiple LLCs over the years to put my eggs in multiple baskets. I do know people who invest in basically one property per LLC. Now, if it's $1 million building, that's not a big deal. But if you're buying little $100,000 properties, that could add up, because every time you create a new LLC, you just created another layer of work, another layer of effort. You got to file tax returns at your provincial level, or in U.S. the state level, and also the federal level, the national level. You've got to have annual meetings, all right? There's a lot of, just because you have an LLC, it doesn't mean it's just providing liability protection. You've got to actually document all that, report all that has to be done. So it's a personal thing, Pablo. let's see, this is Michael Rivard. Hey, Michael, how you doing, buddy? What if you did a 1031 exchange when you sold it? Is that deferred as well? Yeah, 1031 exchange, guys. What we'll do is we'll do another session just on 1031 exchange. But basically, what that is let's say you bought a property for $100,000, okay, and then 10 years later, you want to buy another property for $500,000, and you want to sell the current property that you bought for 100 and use the proceeds to buy the next bigger property. What the U.S. government allows you to do is it's called an exchange, and the technical term is 1031 exchange. I'll just give you the basic picture here. It can be a lot more elaborate. I mean, there's an exchange mediary, there's the owner, and there's the seller and the buyer and exchange mediary. So what happens is the seller who wants to sell the property and buy the other one, if he wants to defer his tax burden on that sale, on the sale of the $100,000 property, the first thing he does, as soon as he decides to sell the property, he has to identify it as a 1031 exchange sale. Okay, that has to be, you have to disclose that. You can't like decide later on you're going to do it, right? Or decide you're going to do it and then change your mind kind of thing. And once you record that, you're now under the radar screen. You're under the scope of somebody's microscope. Okay, that microscope happens to be the federal government. They're going to give you 45 days to identify the next property that you're going to purchase. Now, I want to explain something. A lot of people think you have to identify one specific property. That's not true. You can identify 10 properties if you want, but you better sure buy one of those properties or one or more of those properties. So its identification period is 45 days. I suggest you identify as many as you can in case one of them doesn't work out. You can go to plan B, that kind of thing. Okay. The next thing is you got 180 days to actually close on or purchase the next property from the time you sold the $100,000 property. You're going to buy the next one within 180 days. And by the way, those two rules, guys, 45 days and 180 days. The federal government in the U.S., they don't budge on that. They don't care if you're Mother Teresa or Gandhi. If you exceed one of those time frames, you just violated your exchange privilege, and you got to pay taxes on whatever it is you sold. Hands down, flat out, no questions asked. And I've seen it happen to people. That's why I personally don't engage in 1031 exchanges. I know I'm just deferring the tax burden. And what could happen, let's say life happens. Let's say down the road you lose a job, or you get divorced, or you or your spouse die, or you become permanently disabled. All kinds of things can happen. And you find yourself in a position to have to sell the property, okay? And you can't buy another property because you need those proceeds to live off of. Well, let's say that property was bought through an exchange and you deferred the taxes to that new property. Well, you've got to pay all the accumulated deferred taxes, okay? So the only way that 1031 exchange actually works perfectly according to design is if you die of natural causes and your heirs inherit the property, and then their ownership, as far as depreciation, all that, they start from scratch, okay? So in any case, I just want to, and there's things you can do with companies and LLCs and all that, but way beyond the scope of a 1-hour webinar here. I just want to give you the big picture of 1031 exchange. Okay, let's see. This is from Miho. Miho's asking, okay, do you suggest to us that we should obtain balance sheet on 1 to 4 units rental properties in addition to Schedule E? I actually, Miho, I probably wouldn't do that for a 4 unit. I mean, you can ask for it, but they're gonna look at you like, what do you mean by balance sheet? Well, their tax accountant should have a balance sheet for their business, okay? And you can get that, but I'm really most interested in income expense, your profit and loss, and I want 3 years of that information. Now, in a big building that's been run like a business, yeah, I want to see the balance sheet. If it's a 100-unit building, I definitely want to see the balance sheet. So rule of thumb is, let's say you're looking at, I don't know, 25, 30 units and above, you should probably look for balance sheet. Anything below that, it's not that critical. You can ask for it, but I wouldn't get excited if you didn't get it. Okay, listen to this, guys. Let's go into the final part. I want to make sure we cover this final piece here, since it just came up. What do you ask for when you purchase a property? Okay, so I'm gonna take this right here, and I'm going to actually have Beverly send this to you tomorrow with the recording of this webinar. Okay, you can take notes there now because I'm going to kind of go over these a little bit in a little bit of description. We definitely want profit and loss for 3 years. Okay, I want to go back years because I want to look for trends. Okay, trends of ownership. If I can get more, I'll get more, but definitely I want 3 years. I also want 3 years of rent rolls, and the reason is here's why I want all the rent rolls. What I'm looking for are trends again. So if I'm looking at rent rolls and I see certain units have a lot of vacancy, a lot of vacant columns, or a lot of months where the rent wasn't paid or was paid in partial paid rent or paid late, things like that, I'm going to look at that property. What I'll do is, and you can write this down too, I'm going to go to the local courthouse, right? You can go online and do this too in most cases. And I'm going to look and see how many landlord-tenant complaints have been filed with that property being named. That's either the owner of the property filing them, okay, where the property address is in the filing, it's in the plaintiff or defendant record. If the owner or landlord is filing, it's going to be in the ownership record. Whoever's filing was called the plaintiff. If the tenant is filing, okay, they're the plaintiff, and then the plaintiff, and then the property owner or management company is the defendant. In any case, what I'm looking for is there been a real history of landlord-tenant complaints being filed? Now, by the way, what that means is basically evictions. Somebody's being asked to leave, or somebody's not paying their rent, and they're suing the owner or the landlord because, you know, whatever, they didn't fix the plumbing or something like that. I'm looking for a track record there that's going to tell me that there's a case of mismanagement here. It doesn't mean I'm not going to buy the property. I just want to know what I'm buying. And by the way, this does get asked a lot. I would actually rather prefer buying a mismanaged property than a property with a lot of deferred maintenance, because with a mismanaged property, we can move in there and clean house pretty quickly, all right? With a property with a lot of deferred maintenance, what happens is you'd have to work on that deferred maintenance to bring everything up to code, make it safe, clean, reliable. And let's say it may require you to have some vacant units, or the more deferred maintenance is, the more vacancies, because you've got to work on the properties, which means no income coming in, right? So generally speaking, I can easily take care of bad tenants. I mean, once you get it down to a science, it's you know, pain in the neck, but it's not like it's a impossibility. In any case, rent rolls, P&L, leases for 3 years. I also want to see the leases. I want to see the leases for a couple of reasons. Number one is I want to see what the current landlord has been asking for rents, and what type of terms are in the leases. Because the second part is this. Let's say you have a lease, and most leases will have this, by the way. They have a statement that says, if the property gets sold, the lease survives the transfer of ownership. And I'm okay with that, honestly. I'm going to let whatever lease I inherit run its course and let it go to end of term, and then I'll raise the rents or not renew the lease and remodel the units, things like that. Now, just so some of you who are like in New York and New Jersey, and you know, Toronto, just bear in mind there's certain rules about not renewing a lease. Sometimes a tenant will just agree willingly and say, yep, I don't want to renew it either, and I'll move on. But if they disagree, you've got to have agreement with the tenant when a lease is due to not renew the lease. You got to have a compelling case if you want to enforce it, which is, in this case, bringing something current, like bring a property up to code, for example. In any case, what I'm getting at is I want to see what language is in the leases so I know what I'm going to be inheriting, okay? I'm also looking for something else. And check this out. I've actually seen this happen a number of times. Look and see if the current landlord had collected first and last month's rent in the lease, okay? So what that means is when the tenant moved in, the landlord got the first month's, the last month's rent, and of course the security deposit. The reason that's important is you want to make sure when you do the closing, there's going to be a balance sheet on the closing. What goes out, what comes in, and you want to make sure that those advanced paid rents, and i.e. the last month's rent, is collected by you at the time of closing and not kept by the current landlord. I've seen that happen before. And by the way, once it happens and you sign on the dotted line and you purchase the property, good luck trying to collect those old rents, okay? You have to take them to court, and it's a big, huge pain in the butt. In any case, that's why I like to see all the leases, okay? And assuming they're all the same, I'm going to read just one in great detail and look at all the others for the terms and the amounts and the dates and things like that, okay? Schedule E is pretty much the same thing as rent rolls, but I like to see what they're filing for Schedule E because it shows depreciation. It shows maybe other things that they didn't show on the P&L, okay? Schedule E is generally what they're sending in when they file their federal taxes, okay? Okay, that's the financial stuff you're looking for. Always look for 3 years worth, right? Now, the next thing is this. If you're buying a bigger building, sometimes there's an environmental report that's been done on the property. Or if you're buying it and you have to get a brand new mortgage on it, sometimes a lender will require you to do an environmental report. I just asked for any copies of environmental reports. I also asked for copies of warranties on any equipment they bought, the current landlord, like refrigerators and stoves and things like that. I'm also looking at the list of equipment, snow blowers, lawn mowers, electric eels, things like that go with the property, okay? And by the way, if you do have a big property, you definitely want to have on premises electric eel to unclog waste lines, right? And I suggest you have also snow blower and lawn mower. So if you have a contractor doing snow blowing and lawn care, and they, whatever reason, they don't show up or the contract expires or whatever happens, at least you can have your maintenance guy take care of the place, right? And oftentimes we'll do that anyways because it's cheaper, it's less expensive, right? I also want to see the property insurance policy that's currently in effect. Okay, I'll get my own, but I want to see what they've got. I also want to see the title policy, right? I want to see if there's any exclusions on the title policy. What was excluded for coverage and why? Okay, so you want to look at that. A lot of people overlook that. That is a big, big deal, or can potentially be a big deal, all right? I want to see the deed that was last recorded, see if there's any deed restrictions, okay? Like maybe you want to buy the property and add a enclosed storage area. There might be a deed restriction or restriction preventing you from doing that. So you got to read the deed and make sure that there's no restrictions there that you're not comfortable with, okay? Okay, now vendor contracts, another biggie that people sometimes overlook. Let's say the current landlord has the property under management. Look at the management contract and see if there's anything in there that says something like, this property management contract shall survive the sale of a property, and the management contract goes with the property, okay? What that means is you inherit that management contract, okay, and you're stuck with that management company until the term of that contract expires. I may or may not like that, and you may or may not like that either. If it's being mismanaged, you definitely don't want to keep the property management company. All right, so in my offer, I would write in there that current property management contract must be canceled prior to closing. All right, I want to see pest control contracts because again, you could be tied into something that survives the change of ownership. Plus, I want to see what they've been paying and what type of pests control. I want to see the records. So I want to see what have they been treated for, bed bugs, roaches, what have you. Mice. Laundry contracts are famous for surviving the sale of a property, and that could be some big bucks, okay? Security, if you have security equipment, fire and burglar alarm, secure doors, things like that, those are all going to be secured by a system. You want to look at that contract to see if it goes with the property. Believe it or not, phone landlines can often be tied to the property, and not just in obvious terms, the lines themselves, but the contract I'm saying. Internet service, sometimes there's a deal struck between the current owner and say, Comcast or Verizon or what have you, that you need to be aware of. They've made special concessions and promises you need to be aware of. And of course, lawn care and snow removal, you want to make sure that those contracts, if they have verbiage in there to see that they survived the sale of the property. So that's the basic list of things you look for when you're buying bigger properties, all right? And you also want to include in your language an inspection period that gives you enough time to look at all this. If the size of the building is going to largely dictate how much time you want. You may want a month to go through all this. You may want only a week to go through it, but make sure you got enough time to go through it. And also time for response, okay? So you just go review it, and then you've got time to provide something to the owner that says, I looked at all this, I want to make a concession based on what I saw under vendor contracts, and you have to itemize things, okay? Maybe you're looking for a concession, maybe you're looking to have them cancel some of the contracts, but you've got to respond to your review, all right? In any case, let me do this. Let me go to the question box because we're getting short on time and I see questions popping up there. So let me go back up. We've got several of them, so hang on to your seats, guys. You guys like this stuff, by the way? You like the fact that we're going over this tonight? Because this is, we haven't gone through something like this in quite a while. And this is perfect timing because we've got a lot of people on here who are buying rentals and working with people who are buying rentals. Okay, let's see. Okay, we got Mihu's question on balance sheet. Okay, this is from Peggy. Hey, Peggy's asking, okay, what items do you want for a hotel that has been an assisted living also and has now been out of operation for several years to determine value? Oh boy. Hey, hey Peggy, there's one of our students up in the Detroit area. Kumar is his name. By the way, I think Cheryl Clemens is working with him currently on a property purchase out in Idaho. He buys retirement homes and things like that. If you go to, let's see, if you go to, I know he's a KW guy, so if you go to kw.com, go to Michigan, type in Kumar under name, he'll pop up. And I'm sure he wouldn't mind if you just had him ask him that question, because I never bought retirement nursing home facilities before, retirement/nursing home facilities. But the thing is, Peggy, this list here, you definitely want this list of things because on a property like that, you're going to have all these things: property management, laundry, pest control, equipment that they use, reports that show income, expense, P&L rent receipts. This is the list of things you ask for. So Peggy, the bottom line is this: ask for everything, okay? And then you can determine based on what you get how far you go with this. Because when you're buying a facility like that, you're buying two things. You're buying the building and you're buying the business. You're actually buying two things: the physical building and the business itself. In this case, it's the business of a nursing home. And one of the things you can do is you can go online, you can Google, look for sales of other retirement properties and see what they've been selling for based on square footage, number of beds. You were looking for number of beds in that case, how long they've been in operation, and what they were getting. Basically, if you take the total sales price divided by number of beds, that's how you determine value. So you want to look for that, okay? But also give Kumar a call. He's a pretty cool guy. He's really good at what he does, all right? Also, it'd help if I knew where you were too. Okay, so next one is Peggy. Oh, back to Peggy again. Okay, I guess she's in California. Okay, built in the early 1900s, Northern California, burned, rebuilt, 4 stories including a basement, has shops, nightclub. Holy mackerel! Restaurant, though none are in operation. 50 rooms for lodging. Peggy, you should probably partner with a commercial guy. So do me a favor, set up a strategy call with me, okay? And if you're in the Bay Area, or Sacramento for that matter, I'm going to be out there in December for 2 weeks, the week of December 4th and the week of December 11th. If you can wait that long, I can certainly lend you a hand in person. But if not, just set up a strategy call and I'll hook you up with the right person. I know several people out there in brokerage and also specifically investors who they run the gamut. People are flipping $2 and $3 million houses out there, all the way up to buying $50 million property. Okay, so we have the right resources for you. I just need to have a little conversation about that. So, okay, Cedric, Gary, do you write these questions in the offer? So Cedric, what we do is this: when you're writing the offer, use your standard form. So if it's something up to 4 units, you'd use a residential sales agreement. If it's 5 or above, you use a commercial sales agreement. Regardless, you always identify that there's an attachment or an addendum, and then you put all this in the addendum. Okay, so all this, Cedric, you would put in the addendum or the attachment. Okay, time frames and everything, and that's how you handle that. Okay, let's see. This is Miho. Okay, Miho is asking, when do you suggest to ask for these info to the listing agent? I asked P&L and balance sheet on a triplex and duplex, and agents told me to submit offer first. I didn't really have a client for them, but I wanted to get those info into my booklet. Yeah, a lot of people are going to say go ahead and make an offer, and that'll give them the right to ask the owner for the information. But a lot of times, what you can do is ask for. You might not get everything, but just ask them for a pro forma. So Miho, just remember pro forma. A pro forma is the owner or their agent is basically taking all this information and creating like a one-shot view of income and expense for the property. It's called a pro forma. Just so you want to see the pro forma. That's all you want to see. And then later on, if you like the pro forma, you'll make an offer and ask for the actual details, rent rolls, P&L, Schedule E, and so forth. And by the way, some agents do actually provide that data as an attachment on the listing. You can find those too. Okay, Luann is asking, okay, Luann, all right, is asking for all these documents part of the norm or any reason why the seller would refuse? Yeah, so Luann, just like we just described, a lot of times, and I do this too, when somebody was looking to buy one of my properties, I would provide pro forma. And then when they wanted to see all the details, I'd say, well, you've got to submit an offer. That gives you the right to look under the sheet, so to speak. Gives you the right to do due diligence. So make an offer. Now, if they refuse, I would really I would question whether or not you want to pursue that property, because why aren't they providing the information? Now, if it's a bank, like in the case of a bank-owned property, they're not going to have it. They're just not going to have it. And if they do have it, they're not going to provide it, but they're going to say they don't have it. So if you're buying something from a bank, just be aware that they're generally not going to have a lot to give you. If you're buying from an actual owner, they should have it and they should provide it, because they're investors themselves, and they wouldn't buy a property without all the proper documentation. If they did, they were probably fools, and maybe that's why they're selling, actually, because they got burned. But I would question, Luann, anybody that didn't want to provide it to you. But the only legitimate reason why they wouldn't provide it to you is the fact that it's a bank-owned property. Okay. Pablo says, heck yes, oh yes, love the numbers. Okay, good. All right, Peg is asking, was really a hotel for most of the existence? And we do have students who do hotel investing, Peggy. It's essentially just like buying a rental property. And in fact, if you look at landlord-tenant law, they actually include hotels in there in all the states and provinces. So a lot of times with a hotel, the eviction process is, of course, much shorter and sweeter than if you were renting for more than 30 days. But nonetheless, they'll have everything here: rent roll, P&L, leases. Because every time they lease a room, they rent a room out. If you think about it, when you go to a hotel room, you're basically signing a short-term lease. Okay. Now I don't want to see every single one for every single day. I just want to see an example of what they're using. I want to see one real-world example of the lease that the hotel's using. Now, if the place has been vacant, the valuation, you're going to have an appraiser give an evaluation on that, Peggy, because you don't want to take chances on that. You've got to find out what other hotels in the area are being valued at, what they're renting rooms for that are in comparable condition, and that can run the gamut from Days Inn all the way up to Ritz-Carlton. So if you're not familiar with the hotel motel business, there's people that are in an organization, and I would definitely hire an expert like an appraiser. Maybe you make an offer contingent upon an appraisal, which you should do, and then pay for the appraisal and see what the thing comes in at. Okay. Let's see. Daniel. Okay, Daniel's asking. Okay, Potentially silly question. We are going over this both for ourselves and to be able to speak currently with investors. Yeah, so Daniel, this is for everyone. This is for if you're an investor investing yourselves, you definitely want to use this. And if you're representing investors, which a lot of you are, you can guide them through the process and use this as a template, use this as a guidepost. In fact, if you're writing an offer, guys, and you're using this due diligence, you can send it to me ahead of time, and I'll help critique it for you. I'm not an attorney, okay, but essentially just remember, you want to provide a sufficient time period to review all this and a sufficient time period to respond to your review, okay, to provide them a response. Okay, let's see, Peggy Kumar Baglava, I think it's Baglava, but I'll have to look him up, Peggy. I'll have to look him up. I haven't spoken to him for a couple of weeks or a month or so. I think Cheryl Clemens out of Bend, Oregon was working with him. But I tell you what, send me an email and I'll do an email introduction for you. How about that? When you're in San Diego, so you're looking at this way up in the Bay Area. I know you might not want to drive all the way up there. And I don't know that Peggy, I don't know that I'll be back in San Diego. I know I won't be there in December. It'll likely be, I'm going to guess March, something like that. But regardless, you're in the state of California, you can definitely participate in that property. And let's see if we can help you out there. Mio says performer okay. Yes, performer's okay. All right, Daniel, how does this differ from the T12? Dan, I'm not sure what you mean by T12. It's a term I'm not familiar with, unless there's something in here you saw than something I showed tonight that I've got to go back and look at. So let me know what you mean by T12. Any books you suggest picking, detailing? Do you have one? So Daniel, if you go on to the silver level, so go to myinvestmentservices.com, click on the members area, and then go in there and click on the silver level members area and log in there. If you go all the way down towards the bottom, there's two sets of books. There's free books and premier books. You get the premier books for free because you're a student. So look for there's two books you can get. One of them is called Rental Profits Without the Pain. That's on the acquisition side of rental properties, just basic stuff, but real life story. And the second one is Turning Rental Problems into Real Estate Profits. That's on property management. Again, real life stories and practical information you can use. I actually give you policies and procedures and things like that. Those are yours for free. And if I think of any others, I'll give you, also in the back of those books, I also list other books that I recommend reading to Daniel. Okay, let's see, this is Peggy, says thank you. Okay, Daniel. Grant talks about asking a broker about a T12. I'll look it up, Daniel. That's not a term I'm familiar with. It could reference one of these things we're talking about here. It could be specific to a specific type or class of property, like an office building or industrial space or retail space. It could be related to that. That could be what it's related to. And guys, I think that's it. So that was a pretty packed night, man. We actually went over a lot. I'm surprised we got through that, and I appreciate all the great questions, guys. When you're asking questions, it tells me you're engaged, and I really do appreciate that. It keeps me excited. So, in any case, sometime in November, we're going to have Michael Sojin come on as our guest speaker to go over his book, which gives you a lot of research tools on how to find properties and people and information for your areas when it comes to real estate investing. So look for that. I'm going to have a one-on-one schedule with him, or we're supposed to go over the date he's going to pick and some agenda items. So in any case, thanks guys for everything you're doing. Oh, Genevieve, what about new software? So Genevieve, look for something called Propertyware. Propertyware, P-R-O-P-E-R-T-Y, and the second word is Ware, W-A-R-E. Awesome property management tool. Okay. Let's see. Peggy has another question. Okay. The T12 is the last 12 months of actual operations income expenses, and not some fancy fantasy that the broker has cooked up. Okay, well, thank you, Peggy. So Peggy, so Daniel, this is T12 is the actual last 12 months. Okay, so that makes sense. Income and expenses. So they're really just looking for actual data, not a pro forma. Okay. Thank you very much for sharing that. Okay, guys, I hope you have an awesome night and a great rest of the week here, and we will see you next week, which, by the way, will be on, hang on one second, let me see what night that's going to be. So next week we meet Wednesday, November 1st, okay? We'll see you all then. In the meantime, God bless you and your families, guys, and we'll see you next week. Okay, bye-bye.